Started out very hawkish. Jay Powell's first sentence is we're strongly committed to bringing inflation down to 2% pretty much on a consistent basis. We got more work to do. We anticipate continuing quantitative tightening, reducing our balance sheet as appropriate. And then he, I don't know, 90% of the way through that statement, he repeated those exact same points almost verbatim again. But there was also a balance on the other side, which is reflective of the fact that the Fed realizes that they were way behind the curve. Jay Powell himself said so today, that when we got started, the problem was the pace was important. You'll remember I've somewhat facetiously said that the Fed should raise 200 basis points way back, and I guess it was May. And they basically did. I mean, they did two and two-thirds bites, I guess. But I think that's what's really important here is the movement on the yield curve, because the Fed now thinks that they're going to have the Fed funds rate at 5.1% or so on the dots, and yet the Fed funds rate is already above the two-year Treasury yield. And what tends to happen in these Fed sequential or rapid hiking cycles is the two-year Treasury, as I've talked about many times before, leads the way. The Fed ultimately comes in a little bit reluctantly following the two-year. And after multiple rate hikes, the two-year Treasury is all the way long, is above the Fed funds rate. They're playing catch up. And then the two-year Treasury peaks out and the Fed funds rate keeps going up. And that's exactly what's happening here. So we now have the Fed funds rate above the two-year Treasury. We have many recessionary indicators, including the leading economic indicators, the PMI for manufacturing, the housing market, of course, lots of these indicators, sentiment, and so forth. And Jay Powell said, I think in a moment of ad-libbing, he brought back the Mr. Magoo kind of thing I talked about earlier this year. We said we're going to feel our way. When people were trying to query as to whether they would contemplate a 25 basis point hike, he sort of said, we're going to feel our way. I mean, they're getting pretty close to that 5.1, even if they ultimately make it there, and I don't think they're going to. My intuition is that they're going to be highly encouraged by the inflation data on the headline CPI for the next 6 months. It's going to come down. It's already come down 200 basis points since the middle of the year, and it'll have gone, by the time we get to the May print, we think, that prints in June, we think that the CPI will have gone from a peak of 9.1 a year earlier down to maybe 4.1. And I think the Fed, and that's just because where commodity prices are and where the base effects from last year rolling off some very big monthly numbers. And we now are getting decelerating monthly numbers on the CPI, and I'm having a hard time figuring out why they're supposed to reaccelerate with the Fed funds rate where it is today. So I think that the bond market has completely priced in the fact that inflation is peaking out and going down, and yields are down very substantially. I'm surprised people don't really talk about this. I mean, the long bond yield is down something like 90 basis points. The 10-year Treasury yield is down 75 basis points. And even the two-year Treasury yield is down 50 basis points. And we're at these levels that suggest that recession is coming. And I think Jay Powell said in many different ways of phrasing it that we're going to be definitely softer. We're going to have unemployment go up to 4.6. And the unemployment rate now is at 3.7. And so the 12-month moving average of the unemployment rate is at 3.9. When that crosses over, and I can't emphasize this enough because employment is a lagging indicator, when that crosses over, when the unemployment rate crosses above its 12-month moving average, you're almost assuredly right at the starting point of noticeable economic weakness. And Jay Powell's plot says that the unemployment rate is going to be at 4.6 at the end of 2023. That'll be well above the 12-month moving average. And most economists corroborate that idea. So I don't think there was a lot new here because we've already kind of peaked out on rates, and the market has been anticipating this rapid increase up to the two-year Treasury yield, but it's basically already occurred. So I think we're getting late in the game here. And Jay Powell saying, I'm going to feel my way along. That's that Mr. Magoo driving the jalopy until he hits something. And with the inflation rate likely to go down into the low 4s in just 6 months on year-over-year headline CPI basis, I'm not sure that he'll call that convincing evidence that we're going to settle in at 2%, but it's a pretty vast improvement from 9.1 to 4.1. And I think that's going to influence the Fed's thinking.